So, hey, Daniel, I had a guy come by my office at the bank branch earlier this week. Just graduated college, landed his first professional job, and he was completely ecstatic, as he should be. He brought in his very first paycheck to deposit, but as he handed it over to me, his face completely dropped.
Oh, let me guess. The classic first paycheck shock. He did the math in his head based on his salary offer, and the number on that actual piece of paper didn't match his expectations at all.
Not even close. He looked at me and said, Shanna? Who is FICA and why are they taking so much of my money? He genuinely thought there was a mistake on the company's part.
Oh, and that's a rite of passage for every single worker. You celebrate the big annual number or high hourly rate, but then you meet the reality of taxes, insurance, and savings. It can feel like a massive chunk of your hard work disappears before it even touches your bank account.
It really can. But the problem is that people just don't understand their pay stubs. We had to learn that, right?
Mm-hmm.
They can't accurately plan their household budgets. They build a lifestyle based on what they think or what offer they signed for, and then they make that instead of what they're actually taking home.
And that's exactly what we're going to unpack today. We're going to break down the pieces of your paycheck, clarify the mystery of gross versus net pay, and show you how to read every single line so you can take full control of your actual spending power. Welcome back to Making Sense of Your Sense. I'm Daniel Hill.
And hello, friends. I'm Shanna Browning. So today, like Daniel said, we're going to take a close look at your pay stub. We're going to strip away the confusing shorthand terms and look at how your earnings, your mandatory deductions, and your voluntary benefits work. If you haven't looked at an actual pay stub in years because you're on automatic deposit, then this episode's going to be a major eye-opener.
So, Shanna, first off, let's establish our core definitions right out of the gate so we have no lingering confusion. What is the fundamental difference between your gross pay and your net pay?
So you know me, I'm a visual person. So I like to explain this using that very approach. Think of your gross pay as a really big whole pie.
Okay.
Before anybody else takes a slice. It's the total amount of money that you earned during a specific pay period before a single dollar is subtracted for taxes, benefits, or anything else.
Right. It's the number that's written on your official job offer or letter or your employment contract.
Correct.
If you make $25 an hour and you work 40 hours, your gross pay is exactly $1,000. Clean and simple.
Yeah, exactly. Now, net pay is the actual slice of that pie that is left over on your plate after the government, insurance companies, and your retirement account takes those pieces. Net pay is your actual real take home cash. It's the exact amount that gets deposited into your checking account or printed on your check.
And the gap between those two numbers can actually be shockingly very wide.
Yes,
For
it can.
most workers, their net pay is anywhere from 20 to 35% lower than their gross pay.
And that is right. That's precisely where people get confused or tripped up. When someone tells you, well, I make $60,000 a year, well, their brain registers that they have $5,000 a month to spend. But the reality of that is, after all the adjustments we just talked about, their checking account might only see $3,800 a month.
Which means if they build a rent payment, a car payment, and a grocery budget based on $5,000, they're instantly going into debt every single month without realizing why. You can't build a bulletproof financial plan using your gross income numbers. You have to budget using the net reality.
That's so well said, Daniel. Your gross pay is an indicator of your earning value, but your net pay is your actual spending fuel. Understanding the journey from that big gross number down to the smaller net number is really the first step toward master level cash flow management.
Okay, so let's talk about the slices of the pie that you don't get a choice about, the mandatory deductions. Shanna, when we look at a pay stub, what are the primary government lines that eat into our gross pay?
Well, I think first and foremost, the one that everybody loves to talk about is income taxes, right? So you've got federal income tax, and depending on where you live, state and even local or municipal income
Oh,
taxes.
wow.
And these are taxes that are withheld based on the choice you made on your tax forms when you were hired.
And remember, as we discussed back in our tax day episode, the goal is to have this withholding match your actual tax liability as closely as possible. You don't want them to take too much because that's just giving the government an interest-free loan. But you don't want them taking too little either, or you'll get a surprise bill later.
Yeah, because you're going to pay that for sure. So it's a delicate balance, right? We've talked about that. But then when we get to the acronym that really confused my customer when he came to see me was FICA. And FICA, FICA, FICA stands for Federal Insurance Contributions Act.
It really sounds complex, but it's just the line item that funds two massive federal safety nets, Social Security and Medicare.
Yep, that's right, Daniel. And Social Security takes a flat 6.2% of your gross earnings up to a certain annual limit. And Medicare takes 1.45%. And unlike federal taxes, which can be widely based on your income, FICA taxes are a flat percentage across the board for traditional employees.
And what most people don't realize is that your employer actually matches that contribution on their end behind the scenes. They pay the exact same amount to fund your future Social Security and Medicare benefits.
That's exactly right. And it's a parallel payment that happens on the company side. But when you look at your pay stub, seeing those lines can feel really painful. And trust me, I understand that. It can feel painful because you don't see an immediate return on that money. It just feels like cash just went into a very vanishing black hole out there somewhere.
But it really is important to reframe how you look at it. That deduction is an investment in the broader social baseline and eventually your own long-term stability when you reach retirement age. It's mandatory, it's automatic, and it's a standard cost of working in our modern economy.
Yeah, that's correct.
Hey everyone, Daniel Hill here with a quick question for you. Is your most sensitive financial information sitting in an unsecured metal box on the street right now? Paper statements are one of the primary targets for identity thieves and mail fraud. When you make the switch to e-statements, you're moving your data out of the mailbox and into our high-security digital vault. It's significantly safer, and it's a whole lot faster. You'll get an email the second your statement is ready without having to wait days for the mail carrier to arrive at your house. Plus, you can finally say goodbye to those shoeboxes of paper and filing cabinets taking up space. We keep your statements archived and accessible right in the app whenever you need them. Whether you're hunting for a record during tax season or providing documentation for a new loan. It takes less than 2 minutes to enroll through our mobile app or online banking portal. Protect your identity, clear the clutter, and take control of your records today. Now, let's get back to the show. Now, let's pivot to the deductions where you actually do have some control and choice. The voluntary deductions. This is usually where we see health insurance, dental, vision, life insurance, and of course, retirement contributions.
And that's the section of the pay stub where you are actively designating or designing your financial safety net. So let's look at health insurance first. If you opt in to your company's health plan, your portion of that cost is pulled right out of your checking account automatically.
And the huge advantage here for most workplace benefits is that they are deducted on a pre-tax basis. Now, Shanna, explain why pre-tax deductions are such a massive win for the consumer.
Oh, hey, we like those. We like pre-tax because it's a huge perk. When a deduction is pre-tax, it means that money is taken out of your gross pay before the government calculates your income taxes. So you're lowering your total taxable income.
So let's give a concrete example because it makes it so much clearer. If your gross pay is $1,000 and you contribute $100 pre-tax to your health insurance or your company retirement plan, the government doesn't tax you on $1,000. They only tax you on $900.
Yes, exactly right. So you're essentially shielding that $100 from taxes while simultaneously buying insurance or saving for your retirement. It lowers your current tax bill while protecting your future self.
It's a double win. And speaking of retirement, this ties perfectly into our deep dive last week with Clark Denton. We talked about the supreme importance of matching your employer's retirement contribution. When you look at your pay stub, you should clearly see that retirement contribution line item.
That's right. And trust me, if you do not see it, or if that percentage is set to a zero, you are leaving money on the table. Don't do that. Automating those investments directly through your paycheck is the single most effective wealth building habit you can ever develop. I can't stress that enough because you never have to muster up the willpower to transfer the money manually. You learn to live comfortably on the net amount that remains.
That's great. Now, Shanna, let's talk to the people who use direct deposit and haven't actually opened a payroll document in 5 years. Why is ignoring your pay stub a potentially expensive mistake?
Well, I mean, if they're automated, we tend to not look at them, right? But we need to look at them. So, because payroll departments are run by human beings and human beings make mistakes. So, system glitches, premium rates change without notice, and data entry errors, it's easy for me to say, happen all the time. If you never look at your pay stub, you could be missing out on earnings or even paying for benefits that you never signed up for.
And I've even seen cases where an employee updated their health insurance plan to a cheaper tier during open enrollment, but the payroll software kept deducting the old high rate for an entire year. That's literally hundreds of dollars down the drain.
Sickening, isn't it, when you don't look at it? Or you could look at things like vacation time and sick leave accrual. Most pay stubs track your paid time off balances right at the bottom. So if you work extra hours or you accumulate time off, but that pay stub isn't tracking correctly, you're going to lose out on that compensated time.
So here's the big question. How often should our listeners become stub detectives and actually audit their pay stub? Do they need to look at it every single Friday or every time they get paid?
Well, I wouldn't think necessarily every week, but I would highly recommend a thorough review at least once a quarter or whenever you experience a major life transition. So if you get a raise, verify that new gross hourly rate on your next pay stub. If you change your benefits, check those lines. If the company updates its retirement match, make sure it's reflecting correctly for you.
It's all about verification.
That's right.
You wouldn't hand your wallet to a stranger and say, just take out whatever you think is fair. But that's essentially what you're doing if you blindly accept a direct deposit without ever verifying the calculations on your pay stub.
You're exactly right.
Shanna, this has been incredibly eye-opening walking through the anatomy of a paycheck. So let's give our listener their specific marching orders for this week.
Let's do it. So the actionable tip for this week is the Paystub Audit. Identify every line item deduction on your most recent pay stub. If you don't know how to get it, go to HR. They'll get it for you. But do that.
Sometime before this Friday or when you get paid next, log into your employee payroll portal, whether that's ADP, Paychecks, or an internal company system. Download your most recent pay stub file. Sit down and look at every single line.
Yeah. And don't let a single acronym like we talked about earlier slip by you. If you see an abbreviation you don't recognize, like pre-tax health adjustments or local funds, ask your HR or your payroll representative, because that's why they're there. And they're there to clarify exactly what that means. Knowing where your deduction goes helps you truly understand your take-home power
Exactly.
and how you can budget, right?
Yes.
Yeah. Yep. So, Daniel, tracking down exactly where every dollar goes on a pay stub is truly an amazing reality check. It turns that direct deposit number into a truly real, understandable system.
It really does. And it gives you complete clarity on your cash flow. Once you know exactly what's leaving the ship before it hits port, you can steer that ship so much more accurately.
Oh, so much more accurately, and helps you budget, right? Because we talk
Yes.
about budgeting a lot, right? So you need to know what you can budget on. So now let's take a look at next Tuesday. So we're going to move into an episode that hits the absolute core of our financial safety nets, the visualized cost of debt. Time is money.
Oh, and I am so excited for this one. We're going to look at interest, not just as a financial percentage, but as a total time thief. We'll show you exactly how making extra principal payments can buy back your future timeline.
And as we always tell you, you don't want to miss it, because make sure you hit that subscribe button so it lands in your feed first thing Tuesday morning.
Thank you for hanging out with us today and for taking time to truly make sense of your sense.